What's going on, y'all? My name is Trey. This is Investing by Numbers. We talk all things investing, stock market, real estate, stuff like that. Big video today. As of right now, the S&P 500, the overall stock market, is at new all-time highs. We had a pretty unprecedented move over the last few months. Obviously, we had all-time highs back in February, a 20% crash in the S&P, and now, very quickly, we are back to new all-time highs. So we're going to talk about that. We're also going to talk about Nike. Nike reported earnings yesterday, and their stock's been soaring ever since. Nike is a stock I owned from 2024 into this year, and it was one of the few stocks that I owned that I've been down on the position. So the fact that it's been running, I'm pretty happy with. We're going to talk about Nike, what's going on with it, and I'm also going to talk to you about why I held on to it, didn't sell it for a loss, even when other stocks were outperforming it, and even when the overall market was outperforming Nike. Also going to talk about the stocks I called out at the beginning of June. I had two stocks that were on my buy list for this month. I did buy both of those stocks. We're going to look at how those are doing and just look at some other things going on. It's good to have you. Let's get into it. Welcome. Make sure you hit the like button, guys. It really helps out small channels like us, and subscribe if you want to follow me along, follow my portfolios, the stocks I'm buying. We talk about other stocks in the stock market and get into some real estate. Hit the subscribe button, follow us along. All right, big day today. My Robinhood account is now above six figures. I think that happened yesterday, sitting at just under 102,000. My Schwab account is sitting just under 114. So between the two, I'm somewhere around 215,000 between my two portfolios, all-time highs, as well as right now the overall stock market is at all-time highs today. SPY is broken through that 613 level that we previously hit back in February. I'm going to pull up the 5-year chart here, or let's just pull up the 1 year. So yes, back here in February 19th, I believe this hit over 613, even though Robinhood's showing 612.93. And today, obviously right now, we're sitting around that level as the market has come down a little bit. Today, we did hit a high of all the way to 616, so pretty impressive. Also being that we had a really unprecedented move here in the market. We hit all-time highs back in February. The market got really scared with some of the stuff President Trump was doing, the tariffs and all that. We did have, in my opinion, a crash. We hit over 20% down. We probably, I think from highest to lowest, we were somewhere around 21%. And it happened quick. And in my opinion, that's a crash. Some people would have said it was a major correction. But, for me, it hit a below 20% level really quickly. For me, in my opinion, that means a crash. But we hit back to all-time highs within just 3 or 4 months. Pretty wild. And that's why it's so important to not try to time the market. So many people were talking about, oh, well, I'm waiting for it to go to 30% or 40%. And other people were saying, well, it's the end of our economy and all this stuff. But if you were buying through this period, you've done really well as long as you weren't just picking ridiculous, companies to buy. If you were buying the overall stock market, you did great. And if you were picking great companies, you did great. Just about every single company I bought during this period, I'm pretty sure every single one, all the shares I bought during here are up now. Even though some of my positions might be break even or so, what all the shares I bought at this point are now up. So that is just, it's so important, y'all. I mean, don't listen to the crowd when it comes to investing, because the crowd is usually always wrong. If you're investing, you're looking for these opportunities, and you're not trying to time the market. You're not trying to time a specific, level or anything like that. You're just buying good companies at great prices. Now, I did say, and I said this when we were in the middle of this correction as it turned into a crash, if the market hit below 20% down from all-time highs, I was going to invest more money than normal. I always invest 25% of my pre-tax income, but I did say on this channel that if we hit those under 20% levels, I was going to put in more extra money, and that's how I invest. If we are below 20% from all-time highs, I put in more money than normal into the market because statistically, time has shown that when you're investing heavy during those time periods, you get great results. And basically, on the day, I invested about $4,600 right here at this point, and that money has done extremely well, over the past 3 or 4 months. So let's talk about Nike. Nike released earnings yesterday after market close, and their stock started running. And the crazy thing is, it just goes to show you kind of the crazy time we're in right now, is that their earnings report and their call wasn't even that impressive. It's just the fact that they're on the right track. They're doing the right things to get things back in line. They're making some strategic decisions. They're investing more into marketing and getting back more into, athletes and stuff like that. And, obviously the market loved it. The numbers were decent. They weren't anything crazy, but it caused Nike to run. Now for me, I have been buying Nike. I was buying it in 2024. When the market was at all-time highs, this was a stock that was beaten down that I was happy to buy. Nike's, for me, a company that's safe. They've been, out there a long time since it's been public since the 80s, and it's been around since I think the 60s. But they go through these periods, as a lot of companies do, where they kind of get, they make some bad decisions, revenue declines, incomes decline, and their stock drops. And usually, statistically with Nike, it's like when we go through these hard times, it rewards you if you're patient. Okay, I started buying Nike in November. So when the market was kind of pushing all-time highs back in November, that's when I started buying it. And at the time, that seemed like a great place to be buying. So let's go back to where we were. This is the 5-year chart on Nike. November 2024. So right in here, right in this level here is where we started buying. Obviously, we were in the 70s. That's kind of where my position is. My average cost is 70.5. So I started buying here, and I bought through this area here. And, in a lot of other circumstances, I would have bought more shares as it dipped down lower. But as the market started to crash, there was so many other buying opportunities that had much better returns, in my opinion. So I kind of put Nike on the back burner, and I focused on those companies that were going to give me better returns. Now, as we were getting ready to progress, I think I even mentioned it on my last video or a couple videos ago, that if we would have stayed at this level, I would have started to probably pick up more shares of Nike now that the market's starting to run again and Nike's still beaten down. But I don't know if I'm going to do that. We're starting to see a run up, but we'll see what happens. And we could still reject and come back to this level. And, I might be in the market to buy more shares of Nike. But obviously in the past, let's see here. We'll go to the week chart. Yeah, yesterday afternoon, right after market close, we ran up from $62 a share, and now we're at, almost 72. So big jump there. And now, one thing I want to talk about too is, since I've been doing this channel since I think the end of December, I've gotten comments about Nike, people saying, hey, why are you holding that? Why are you buying Nike? And the truth is it was a decent buy, at the time. At the end of 2024, we talked about that. It was a great place to be buying Nike. And as the, macro environment changed, I just moved it as a hold for me. And a lot of people, were saying, oh, you need to ditch Nike, ditch Nike. There's a reason I didn't do that, and it's because when you buy these stocks, if you're making the right decision at the time, you got to give them room to breathe. Because let's say I would have decided, right now SoFi is a better buy, Zeta is a better buy, Adobe is a better buy, and is going to give me better returns. And let's say I sold, a week ago, and then I just missed out on this big jump. You never know what a stock's going to do. And if you're buying a good company and it's at a good price, even if it's below your cost average, you still have the opportunity for that stock, if it's at a good spot, to make another run. And you're going to miss out on that if you just get impatient and sell. So it's always smart to go over the stocks you have in your portfolio. Question yourself, question your own biases. Is that stock still a good hold? Whether you could sell it for a profit, or even if you had to sell it for a loss, is that stock are the fundamentals still good? Is the price still good? Because even if you're down 20 or 30%, but the price the stock's at looks like it's in a really good place, You could buy more if you wanted to, or if you're just capped and you don't want to invest any more in that particular stock, or you feel like your money's best suited elsewhere, you're still holding a company that's sitting at a great price. And that company may start to move back up and increase their numbers. And then your portfolio is coming up with that stock, even though your cost average is below what you bought at. So just because you're down on a position and it's not doing a whole lot, that's not concern to really sell out of your position. If you're buying the right companies at the right prices, hold on to these stocks, even if you're not interested in buying more shares lower, because things are always moving in the market. Things are always changing, and companies change. I mean, Nike could have started getting worse and worse and worse fundamentally and kept going down. And, I could have made the decision at that point maybe to sell for a loss, but, they've been recovering. They've been doing well. They've got new leadership in the past, year or so. And, I feel like this position will do really well, over the coming years. Whether I hold it for a year or 5 or 10, I don't know. We'll reevaluate Nike as times progress. So the next stock I want to talk about that I'm looking at that, is looking pretty good right now. I've talked about it before on this channel, Lululemon. Lululemon is a company that's garnering a lot of negative attention. Their stock is extremely beaten down, over the past couple years. Let me pull up the 5-year chart. So yeah, we're negative. We're down on 5 years. We're down 22% on the 5-year chart. So we are just getting murdered out there for Lululemon. I say I don't own any shares, but I'm definitely thinking about picking some up in the near future. We hit a high here back at the end of 2023, over 500 a share, and now we are over 50% down from all-time highs. We're at 232, and it's just getting destroyed. So now a lot of people are very anti-Lulu right now. They think it's a failing company, but this is why it if you're a long-term investor or a stock investor, it really benefits you if you have the mentality of to go against the grain, or maybe to be an individual thinker, because the overall stock market is kind of like the crowd, and the crowd can be a mob and have a mob mentality and really just follow the news almost too much, So anytime something bad starts happening with a company or numbers start kind of declining, they just go crazy and sell off. And they usually go really hard in whatever direction. Now, being a nonconformist can also hurt you if you can't overcome your own biases, and sometimes, if you're one of those people that just wants to short the overall market because you think that the market, is eventually going to be doomed one day. A lot of times that mentality, or just about all the time, unless you can time the market right, will destroy your investment. And it's not even an investment, it's a gamble. Anytime you're shorting anything, you're gambling, because it's just, you can go further than zero. If you invest in a stock and it's at $10 a share, if it drops to zero, you lose 100% of your money. If you short a stock at $10 a share and it goes above 20, you're now owing money. You're now past the 100% mark, and you're going further into the negative. So very dangerous to get into the short world. I really don't mess around with shorts. Overall, I'm a long time kind of guy. But anyways, back to Lululemon. Right now, of course, the numbers are, revenue growths are slowing down, but we're still seeing good growth, and they're still, opening new stores. I just listened to their latest conference call this morning. Numbers are still growing, and year-over-year growth is still happening, even though it's slower than before. But one thing to look at, their numbers are really important here. Their PE ratio is, almost down to a 15. It's a 15.8. And this is a company that's seen exponential growth in the past few years. And we're about to look at their PE ratio here on macro trends. But it's wild because, people get so, overblown with these opinions of a company's going down. And to be honest, they're doing just fine. The numbers are good. Growth is slowing down, but does that warrant dropping all the way down to a 15 PE? Only time will tell, obviously. But, looking back at the last 15 years of PE ratios for Lululemon, the lowest we were seeing, was in the low 20s. Right here, 23. Right here, it dipped down to, around 24. But our highs, here's 57. Up here, we got all the way up to about 80. Our highs here were around 50. And then last summer, we dipped down to a 20. And now we're down to almost a 15, just under a 16. So PE ratio wise, pretty impressive of a value for Lululemon, even if their numbers are slowing. But let's check out what we're seeing here, because the most important thing to me is, yes, with any company, growth is going to slow down. You can't just double your revenue growth year over year forever. It's not going to happen. No company can do that. The longer you go on, the more you start to slow down. And some of the most well-established companies in the world that have been around for decades, 8% revenue growth year over year is really good for them. And they're trading, and a lot of them trade, well into the 20s, if not the 30s PE wise. Amazon is one of those companies. But let's hear, this is the revenue chart for Lululemon. And for trailing 12 months, look at this. I mean, ever since, where are we at here? 2020. Ever since 2020, we've had a steeper increase than the times before it. And this is, quarterly numbers here. We're starting to plateau a little bit, but we're still seeing year over year revenue growth. I mean, and even back here, we had a plateau. And that's where, if a 5-year chart, the 5-year chart is showing us right now the stock price below where it was here, and we've had all this revenue growth despite it, okay? Net income, we'll see about the same thing. But, is this drop in Lululemon really warranted? Or is it just hype in the wrong direction? Net income, look at this year-over-year net income growth. These 2 quarters basically were about break even. But look at this chart. I mean, tremendous, net income growth year over year. And we've had a few down quarters quarterly, but overall, year over year, we've got good, steady growth here. I like it. And let's check out the income statement and balance sheet. I'll look at the balance sheet first. Lulu's got a great balance sheet. They're run really well. Cash on hand is almost $2 billion in cash on hand. No long-term debt. All right, so no long-term debt. We've got $7.6 billion in total assets, and we've got just under 3.3 of total liabilities. So over 100% or over a double up in total assets than liabilities. I really love to see that. And cash on hand obviously has been growing. Back in 2020, we had just over $1 billion, and now we're closing in on $2 billion in cash. So the cash flow on Lululemon is looking really good. And their income statement, their growth has been phenomenal. And even though growth is slowing right now, we could pick back up. If I'm running my own projections, and I'll link, I did run projections on Lululemon a month or two ago. I'll tag that video at the end of this one. But if I'm running my projections, I'm just going to assume that revenue growth will kind of slowly decline from where we're at, or maybe stay even a little bit. But I'm not going to assume that it's just going to start going up again. But here's the thing, it totally can. We've seen plenty of companies do that. Companies like Amazon have done that. They've hit a 2 or 3 year period where revenue starts to slow down year over year, and then it picks back up. I mean, a lot of times these companies are reliant on the overall macro trends of our economy, and sometimes we hit slow periods in our economy. The consumer's not buying as much, especially from a clothing company like Lulu, and but then when the economy starts to boom again and people feel safe, they start spending money on clothes and other things like that. So looking at 2020, our revenue was just under $4 billion. And then we had a 10% growth here, $4.4 billion in 2021. Big jump to $6.2 billion in 2022. Another big jump, 8.1. Roughly a 20% jump into 2024 with 9.6. And then this past year into 2025, that's where we had a little bit of slower, somewhere around 9%, maybe 10%, but I think somewhere close to 9% year over year revenue growth. But guys, 9% is still really good for a company. And a company trading at a 15 PE, I will take it any day, especially when in the past when that company's had growth like this, and a company that still has plenty of room to grow in foreign markets, and they're doing really well in Canada, but all over Europe, they're opening more and more stores. Net income, obviously, the same thing. In 2020, we were bringing in around 645 million, and now our net income in 2025, 1.8 billion. So basically a 3x in the last 5 years in growth of net income. So, for me, I like Lululemon. The numbers are good. I think, if this thing was sitting at a 40 or 50 PE, yeah, okay, I might not be interested. But the fact that we're trading close to a 15, very impressive. But a lot of people are just really down on the stock. Now, does that mean that it can't still go further into the red? No, it totally could. I think it's unlikely, though. I think Lululemon is probably somewhere close to a bottom stock price wise. It may not be, but if it continues to go down and these numbers still look similar to what we're seeing, I'll keep putting more in. Now, obviously, a lot of people are, say Lulu's a one-trick pony. It's basically just athletic wear. But this is a huge market, big industry right now. And I think that it's, there is more risk involved in Lulu than, let's say like an Adobe. Adobe is a lot safer of a company to invest in, especially at their price point, even though it's a higher PE right now with Adobe. A company like Adobe, if it stays where it's at, I could see myself, making Adobe 20-30% of my portfolio, if it kept hanging out where it's at or even going lower. But a company like Lululemon does carry more risk with it. I'd probably cap my position size around 8 to 10% of my portfolio. I most likely wouldn't see myself getting to that size, most likely, unless it stayed at this level for well over a year, or unless I sold another position and moved it partly into Lululemon. But most likely, probably a 5% is probably as far as I'll get with this. But I would be willing to bring this up to 10% of my overall portfolio. But I wouldn't want to go further than that. I would say, this one holds a little more risk than normal, but I wouldn't call it super high risk. Companies that don't have positive net income growth, or that are newer companies, those to me are the ones that I definitely like to keep below 5%, if not up to 3%, depending on the company. But Lululemon, I'd feel safe making this up to a 10% of my portfolio position at these prices, below a 17 or 18 PE. Yeah, I would say, really up to a 20 PE, I feel like Lululemon's a good deal. So yeah, most likely this thing will get added to my stocks I'm buying in July, and I don't think I'll be investing any more money in June. I don't think I'll be putting any more money in my portfolio the rest of June, but definitely going into July, this one will probably be on the list. So tell me what you think in the comments below. Are you in the mindset that it's a good deal? Are you in the mindset that it's going down? Tell me what you think. Comment below. So for the stocks I was buying in June, the stocks that were on my list for the month, I only had two, Zeta Software and SoFi Technologies. So these stocks have already jumped up a decent amount. Zeta, I was able to pick up 87 shares throughout the month. Software company, they do business software to enhance companies' numbers, basically business running software. They've had great growth. If you want to look more into Zeta, I'll tag the video for my stocks I'm buying in June where I went into a little more detail. But I was able to pick up, a decent amount of shares, nothing crazy. It's a small position. Right now, it's only just over $1,300. But in the past, month, as I've been buying it throughout the month, that position's up 7%, which is phenomenal for, less than a month. But I did pick up, what do I have? 87 shares, small position. but I think Zeta has a lot that it can do. Now, this one's a riskier stock as it's a lesser known company, smaller. They are not yet fully profitable yet. So, this is definitely one that I would keep well under at most 5% of my portfolio, but probably more like, I'd probably cap this one more like 3 to 4%, depending. But they definitely, their stock price has been beaten down over the last couple of years, as you can see. Here we are, but maybe this is the beginning of a run, and if so, that's cool. My position will stay where it's at, really small position, or if not, if it stays in the area, maybe drops back down, I will be investing more into Zeta. Now, the other stock, SoFi. I feel pretty good about. I really like SoFi. I wished I could have bought some shares earlier, but with SoFi being kind of a new fintech banking company, as we were seeing that market crash, I do get nervous with banks, to be completely honest. Even though SoFi is more of a fintech company, anything in the financial world that relies on loans and credit or interest rates and all that, I do get nervous about, especially a newer company. So for that reason, I was a little skeptical on picking up shares of SoFi. But now as the market's kind of running to new all-time highs and things are looking good, I like where SoFi's at. I mean, they've got great numbers, great revenue growth. I went into more detail on my last video, stocks I was buying for June. But I've been able to pick up 75 shares. This is around the same size as my Zeta position, as I was buying both of these stocks kind of equally. Originally, I had said that $18 a share was kind of my cap. I might be interested in picking up more shares in this area in the 17 range, but I definitely think I'll cap it at 18. Preferably getting shares under 17 as my cost average basis is 1556. But this is another one that is pretty incredible. Almost a 10% gain in less than a month. I started buying this one at the beginning of June and bought it throughout the month, and 10% just done really well. And it's had some decent growth over the past few days, a couple weeks. So I'm happy with that. Now, SoFi is one of those companies I really would love to build a bigger position here. I think SoFi can do really great things over the next few years. But if this is as big as my position gets, for the near term, that's okay too. There are other companies out there that I'm liking. Adobe's one of those. My position was up 10 or 15% at one point in time in Adobe, but now it's back to about break even. So I am definitely going to be buying more Adobe if it stays where it's at. I really like Adobe. I picked up a fraction of a share, I think a quarter of a share this morning with about $100 or so. A real small buy, but still happy to put that money into Adobe. I think it's just my Adobe position might be up 0.5% or something like that. But Adobe's a really safe one, I feel. SoFi, might be another one of those where I would be willing to bring it up. Definitely 5%, but I wouldn't go higher than like 10% on a company like SoFi. But 5% would probably be about as high as I'd like to get with SoFi, just because it is in the banking and fintech sector, and it is a kind of a newer company. I mean, it's been around a while, but nothing like Adobe or a Nike or an Amazon or something like that. But both those stocks that we listed in June have done really well. Both up, well over 5% throughout the month. So if you were buying those as I was buying them, as we called them out at the beginning of the month, good job. Congratulations on those gains. Small gains, nothing huge in the grand scheme of things, but within a month to get even 5% on your money in a month is really impressive. So anyways, that's about it for me, guys. I just kind of wanted to go over some of the things that are going on in this market, and really just bring to light how fast things can change in this type of a market as we approach new all-time highs. Today could have been kind of a new top, and we could run sideways for another year, 2 years, whatever it is. We have no idea. President Trump can be. He likes to manipulate the stock market a little bit. He's kind of all over the place, but If you're taking advantage of those time periods where things, tend to get a little scary, and if you're trusting the underlying fundamentals of what you're buying, if you're buying great companies and the prices are good, you'll do very well. Even if the market runs sideways, we've had lost decades where the price hasn't changed for 10 years in the stock market, but there were companies during that 10 years that just ran extremely high. So if you're picking those right stocks, you'll do well. Pay attention to what you're buying. Keep having an open mind. Don't let your biases get in the way, and just stay patient and stay on that path, and you'll do really well in this game. Anyways, that's it for me, guys. But we'll catch you all on the next video.